Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY, the Qs, and IWM. As always, after that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of the video, I've got 2 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick off today's S&P analysis with the sectors as we always do. Who was leading, who was losing, and where was the weight? Leading the pack today, we do see the XLK. Fantastic. That is the tech sector, the heaviest weighted sector of them all, up 4.3% as measured from the prior day's close. From this morning's open, it was also up an impressive 2.61%. It was the true leader on the day's session. Down at the bottom of the barrel, we see the XLU and the XLRE, depending on how you want to read it, from column number 1 or column number 2. Nonetheless, everything was green on the list. They were just up the least amount, right? It's also not the end of the world, noting that both of these sectors are lightweight sectors and defensive in nature, so no big deal to see them lagging on today's massive breakout, which brings me to my next point, the FOMC meeting, the Fed. Geez, it was a crazy day to the upside, but we are going to stick to our process so we're not blinded by the Fed move and we can see things as objectively as possible. So knowing that, where were the heaviest weighted sectors? Of course, we already covered the XLK being the heaviest of them all, leading the pack today, so that's a great thing to see in terms of relative strength. After that, we've got the XLF, the financial sector, second heaviest weight that we're watching, sort of midway through the pack, but still up a very impressive 1.54%. That checks out as being bullish. And then the XLV, it certainly did lag in terms of its placement in the list here, but nonetheless, again, still a nice positive day there, up 0.63% on today's session. Let's go ahead and check in on some of these structural charts, though, and just see how the trends are continuing to unfold. Are these reversals really firmly strong, or should we be skeptical of these movements? And I think what we'll find is that things are panning out just wonderfully, beautifully, to be quite honest with you. So in the XLK, the tech sector, to kick us off, you can see that we have a beautiful break, retest, and now we've rallied higher. We gapped green over red. We talked about that extensively in the pre-market live stream. That was a bullish setup, and now we have actually even set a new higher high from here to here. So everything about this chart structurally is checking out for a firm reversal back to the upside. The bulls do appear to be in full control here in the tech sector. I would say, based on the activity that we saw on today's session, we are looking for upward lift to continue to get us into the top of this prior balance range from right around in here. That number is 143.31. Of course, that would be good bullish pressure for the S&P 500 overall. If we do pull back, it's still okay. We can afford another higher low because, remember, as we just pointed out, we did technically set a new higher high. Where would I want to see a higher low pullback occur? Ideally, somewhere to the midpoint of this range or better. That would be like rainbows and butterflies. Not so ideal would just be remaining above 134. There's really no reason to get bearish again in the tech sector until we break back down underneath 134, which, as we know, quite simply was the big breakout point from this ascending triangle pattern right around in here. So everything about the XLK checks out as being in the bull category. Let's continue along and see what's happening in the communications sector. This one has been a thorn in the side for the S&P 500. Remember that in the live streams, in the updates that we've been putting out, we certainly have been discussing the fact that this was the first sign of a fake breakout. We had a 2-day balance accepting above, and then late last week, last Friday, the pullback actually breached the top of the range. We closed beneath 57. Now, we're not quite back above it yet, but notice the critical structure that held here, which of course is the higher low phenomenon being dictated by the support trend line. So is it the end of the world? Not really, but it's certainly not nearly as bullish. Please don't misconstrue this as what we literally just saw in the XLK. So yes, a nice hold for a higher low, but we really have to prove it with the next higher high here and get back above this level at 57 in the XLC. And with Meta reporting earnings after the bell today, we'll take a look at that chart. We'll see ultimately what impact that may have on the communications sector. So looking for higher, ideally in the communications sector, up and over 57 into the remainder of the week, based on the bullish momentum that we saw on today's session. For pullbacks in this one, we do have a level intraday around 56.36 that we want to see hold for a higher low, and then something like that. That would be optimal for uptrend. Anything that's a deeper pullback starts to just become a little bit more neutral here inside of the XLC. Next up, consumer discretionary, XLY, right? So this one, we were also fairly concerned this morning with the open literally right on this area here. That's where the close was from the prior day's session. This struck me as fairly concerning. If we were to have breached 148.25 to the downside today, that would not have been a bullish look. Clearly looking more similar like that XLC communications that we were just on. But what happened instead, right? Let's read the chart for what it's saying. We filled the gap overhead and we actually closed back inside of the 2-day pullback that we saw originally from Friday into Monday. So everything about this chart is certainly screaming again, healthy, bullish, no problems here. We have a break of the level, a pullback retest of the level, and now we're trading back higher. Everything about this starts to scream bull flag consolidation. The next breakout clearly is up and over 157. So monitor that for some more upside here out of the XLY. I would say that the chart looks healthy for either neutral to bullish continuation into the remainder of the week. The energy sector, let's move a little bit more quickly through some of the lighter weight sectors here. So energy, really no concerns. It continues to go sideways in this overall area. You could start to look at it as a bit of a possible inverted head and shoulders. There's a little bit of work to be done before that's truly in play. I would say as long as this is not leading the charge with an aggressive breakout up and over 76.84, we're all good inside of the energy sector. It doesn't strike me as a large concern going sideways down here, and it's also not going to be an overly bearish drag unless we were to breach some of these lows here closer to 68 and get out of this sideways range that we've been in. Remember that energy is D for defensive. It's a lightweight sector. As long as it's not leading the charge and as long as it's not making new lows, no red flags in energy. Next up, XLI for industrial, 7% of the S&P 500, as we've been repeating over and over and over again, now that we've learned that, yes, it's not technically as light as we originally thought, but nonetheless, XLI, what's it doing? It is breaking out of a multi-day balance here with a close outside on substantial volume here. So the look, of course, is for continuation, especially when we look left and realize that there's virtually no structure from when we were moving lower right through here. So are we technically, okay, we didn't close in the gap, but very close. I would say if we can get back above 92.15, we've got some clearance to close that gap up here towards 93.60. And of course, that is just bullish pressure for the S&P 500. Is it going to make or break us? Not really, but it will just be an added boost, if you will, if the XLK continues to rally, if the XLF continues to rally, if the XLV continues to rally as well. My concern for downside would only come if we were to breach 89 and get acceptance back down underneath that level here. Next up, XLF financials, really great looking chart here as well. Remember that we needed to see some relative strength come into the financials, and it's certainly here. We do have sideways consolidation instead of a breakout, but the most important part about this chart is just the fact that we continue to hold up above that 32.45. You know, I'm not so concerned that we're not breaking out. I'm really just encouraged to the bull side, honestly, that we're not breaking down underneath 32.45 even after subsequent tests. 1, 2, 3, 4, opening fairly low inside the prior day's range today. Again, the fact that that didn't break down is telling me just as much as if this were to have broken out per se, right? So for all intents and purposes, the XLF continues to look great. Obviously, the gap is what we want to see fill overhead for some more bullish pressure in the S&P 500. Could that happen into the remainder of the week? Absolutely. Absolutely. We've really just been consolidating in this flag area. We are looking for a break one way or another. I would be concerned if we were to take out that 32.45 and not make a higher low at this 32 level, right? If a breakdown of this does come, because ultimately we are just in a range, be mindful of that. Sure, it's a bull flag range, but if we do break down from it, it's got to produce a higher low here for a bounce at 32. Otherwise, what do we have, right? Pretty much a failed move outside of this larger term range, which would be concerning. That 31 would then be the target on a look above and fail. So it's got to hold 32, worst case scenario on a breakdown of this balance right here. The chart does have more bullish than bearish implications, especially with the volume and the close that was solid up towards the highs of the bar today. So gap fill is the higher probability scenario that we would want to be mindful of into the remainder of the week. Of course, being bullish pressure for the S&P 500. Continuing along, XLB materials, lightweight sector, very similar to the energy sector. Inverted head and shoulders look kind of going on in here. No big deal if it wants to break out. Fantastic. It's not defensive. Is it going to save the day? Absolutely not. Is it going to break the day if we start making new lows, or rather just fail the inverted head and shoulders? Not really. Would I be concerned if we start taking out 70? Yeah, that would definitely be a little bit of a cause for concern, but currently currently the look is not for a breach of 70. So neutral, no red flags in the materials sector. Next up, XLP, consumer staples. This is an interesting one, especially with the FOMC and sort of the inflation talks that Jerome Powell gave in his press conference today at 2:30, of course. But what do we see in this chart? Certainly a breakout of this multi-day balance, multi-week balance, right? So for all intents and purposes, this bull flag is breaking out here, and it's lagging the breakout that we saw in the XLK, which is fantastic. Again, this is D for defensive. So the fact that this is moving up higher after the fact, after technology already broke out, after consumer discretionary already broke out, fantastic. Great look here in the XLP. No concerns with this chart. Again, it supports the thesis that we are seeing a bullish reversal here in the S&P 500. XLV, the healthcare sector, second heaviest weight by market cap. Let's dive into it just a little bit here. We know we've been discussing, oops, if I just scrunch this up a little bit more, here's our monthly range. I just want to bring a little bit of a larger time frame perspective back into play here. Look below and fail, break, retest, and hold, and now we're moving back higher. We're basically at the midpoint of the monthly range here, bullish, right? On a look below and fail, over time, the target is the top end of the range, and that pattern is still in effect if you were to have looked at this on like a monthly time frame chart. So is it going to take a while to actually pan out? Yes, but are we doing it? Yes, also yes, right? So that is a bullish implication for the marketplace overall. Again, remembering that this is the second heaviest weighted sector by market cap. I like the fact that we broke out and held up above that 130.50-ish zone, especially after printing an inverted hammer on the Tuesday session. This 200 SMA is acting as a thorn in the side here, so we do want to see if we can close a daily bar above that. For all intents and purposes, this breakout can continue here. I'm not concerned with this being overbought because these two-day ranges are obviously back to back. There's really nothing extended about a move quite like that in the XLV. So looking for more upside here, midpoint of the range, just continuation. Anything that basically holds outside of 130.50 now is continued bullish pressure for the S&P 500. Real estate sector, lightweight sector, not going to spend a whole ton of time here, just continuing to grind higher outside of this box. Sure, it's a little bit of bullish pressure, but it's so lightweight, it's not going to save the day or break the day if it decides to go for a tumble and make a move back down towards 40.26. If we were to take out this level, 38.50, yeah, a little bit more concerning, obviously, but the chart certainly would not suggest that. Next up, we've got the XLU for utilities, just like energy, defensive, lightweight sector in the midpoint of this overall range here. It does not strike me as a concern. We don't want to see it breaking up and over 72 aggressively, which it's not, and we also don't want to see it underneath 68.23 aggressively, which again, it is simply not doing. So no major red flags here in the utilities sector. Let's go ahead and take a look at our ratios. I'll quickly pull these up. If you don't know how to set this up, I've got a video for you in the top right-hand corner describing what this is, how you can set it up, and also kind of, what the implications are. I suppose we'll get into some implications right now, actually. The top four on this particular build are the heavyweight risk-on sectors, and these are sort of telling us currently that risk on is definitely back on the table, right? Look at the XLK. Instead of being in this slump, remember it was in this descending triangle, we've clearly broken out. We've reversed trend. This is a higher low. The 50 SMA is perking higher. 50 SMA, by the way, is the yellow or gold line on your screen. So I would say this falls into the bull category. That is risk on. If we take a look to the right, the XLV, second heaviest weighted sector by market cap, what do we have here? Higher lows continuously being produced, still trying to move higher here overall in an uptrend. That is a risk on indication. What do we see in the XLY? Same deal. Remember that we had this sideways malaise. Now we're breaking out higher low, like a break and retest almost, and we're pointing back higher. This certainly would indicate to me more of a risk-on feel. The only thorn in the side is still that XLF from a relative strength perspective. We know that it's been sideways in that daily range that we were just discussing. If we filled the gap overhead, I do believe that this would want to perk up and at least get to the 50 SMA, which would be more of a neutral indication. I would say it's currently bearish to neutral, right? It is technically in a downtrend with lower highs continuously being produced, but this could be a higher low, right? So bearish to neutral in the XLF, but overall 1, 2, and 3 of the risk-on sectors are firing to on. I would certainly say that's enough to reverse the sentiment to risk-on, turning back on. The bottom 4, turning risk off. How are we doing from that perspective? Certainly the XLP, sideways, A-OK, perfect. No big deal there. That to me is a more risk off being off indication. Same thing in the energy sector, sideways underneath the 50 SMA, which is ultimately sideways. So that to me is also risk kind of off being turned off. Real estate, same thing. I'm not going to say that tongue twister again. And the XLU, exactly the same thing again. Descending, lower highs, lower lows underneath the 50 SMA, more risk off, turning off. So to me, the sector ratio grid is still pointing us to more of a risk-on marketplace coming back into view, and it has been that way for quite some time. I really do pride the analysis on being extremely thorough, and if you go back and watch all of the videos where we've been talking about this turn in the marketplace, I really do think that this is a critical component of the analysis that has kept us on the right side of the market as this turn has been unfolding. So it is useful stuff. It's kept us on the right side. Hopefully this analysis has kept you on the right side. Let's continue along here and take a look at some behind the scenes things. First up is going to be the ultimate sort of thing to talk about today, which is the TNX, the 10-year interest rate, right? Why is it so important today? Because, of course, we got the FOMC Fed funds rate. We got the sort of conference from Jerome Powell as well. They gave us, as expected, the 75 basis point increase in the Fed funds rate, right? So that ultimately was what the market was expecting. Therefore, we didn't have any major shocks, and the market really rallied based on that. Now, again, sure, we rallied based on this, but were all of the underpinnings of the market set up for a breakout anyways is the question I would really encourage you to ask yourself. What I mean by that, were the sectors poised in a position where if we took out the tops of ranges, could the market break out? I would absolutely 100% say yes, that was the case across the entirety of the market. This was just the excuse for the market to move higher, right? So FOMC went great, obviously 75 basis points as expected from J. Powell. And during the conference, he actually gave something that he hasn't given in the past. And I usually don't read too much into, what he's been saying and this and that. But he reaffirmed that the SEP, Statement of Economic Projections, were correct from the last sort of release. Now, usually there's a revision that takes place. They say, we were slightly off. We're going to do this and that. But he stayed firm to what he said last time, which meant that the target rate is going to stay the same. So going forward, essentially, I don't think that on the table any longer are 100 basis point rate hikes. I don't think on the table anymore are 125 basis point rate hikes. It's just not there. If we're going to hit that target rate that he's outlined for us, we're either going to get another 75 come the next meeting, and keep in mind there is no August meeting. The next one will be September. Then we're going to get a 225s, right? 25 times 2. So let's go like this. So 25 basis points times 2, and that'll bring us for 125 basis points total from where we're at currently into the remainder of the year. Or we could get the possibility of 250s. So, I've done it again. So I'm just going to do that, and you'll make note that that is a 50, not a 58, really cruddy drawing, but you get the gist. 50 times 2 and then a 25 after that, and we still get that same net effect of 125. The reason I bring all of this up, the reason we're reading into this today, is because these are off the table, and that is what the market feared. That's what would have caused the market to sort of take a big fall, in my estimation, when they came out of nowhere and said, surprise, 100 basis points. And that, based on what we've heard today, is so far off the table. So I think that draws a tremendous amount of risk out of the market, and that's ultimately why we saw the rally. The other thing that we can point out here from the TNX is that there was virtually no response. Even though we got a 75 basis point rate hike, the TNX actually dropped lower. Now, why is that? Because in here, we were pricing in, or, the bond market, they usually say, is much smarter than the stock market, right? Take that, with a grain of salt, whatever. But this was pricing in all of the rate hikes that would have needed to be done based on the inflation, right? And this priced in that, yes, it was ultimately transitory. And now that we're close to a neutral rate, as described by Jerome Powell, we're at that neutral rate, 2 point whatever it is, really, excuse me, the TNX is going sideways here. It's not doing anything even with these massive rate hikes. So what does that tell us? Again, I think that the bond market got it right here, and we're not going to be getting any of those nasty 100 basis point surprises. It just doesn't seem like it's in the cards at this point in time. So that was a little bit more in depth from the fundamental side than we usually do. If you appreciated that outlook, or maybe just the information, if you didn't know that, if you knew that, but you like to hear the sort of reaffirmation, then great. Let me know in the comments section. Maybe we'll do it again next time when we get an FOMC. Moving along. Let's take a look at the VIX. This is the volatility index, of course. And what do we see here? Again, this is kind of a red flag. So we've been talking a lot about really bullish things so far. However, in the VIX, what did we see here? A very, very nominal day to the downside. Nothing crazy, especially considering the rally that we saw and the amount of euphoric sort of movement that was there. I would have imagined the VIX could have come in a little bit more aggressively, and it didn't. So this to me is a bit of a head scratcher. Don't get me wrong, it's still moving in the right right direction towards that 2050 level, but it's not quite acting properly on its journey there. So it's not the end of the world, but it is a small data point I'm keeping in the back of my mind to say, all right, volatility didn't subside as much as I would have thought. And maybe, just maybe, the reasoning behind that is because we're not all the way through earnings season yet. And after earnings season, some of the volatility will be sucked out of the market as well. Just a thought. So this is a little bit of a red flag that I'm carrying forward. The other thing that, of course, we've been talking about recently is the VVIX, which is the volatility of the volatility index, indicating that no one's still buying SPY puts, no one's still buying VIX calls, no one's hedged properly. We've done that spiel a number of times. I do want to reiterate what we talked about last time, which is the gamma squeeze, right? The fact that no one's buying SPY puts, if everyone's buying SPY calls, then again, think about the delta risk on the dealers. So the dealers are negative delta when they sell you that call as a market maker. To get back to positive delta, or at least neutral rather, they go out and they buy ES futures. They go out and they buy SPY shares, right? And that neutralizes their delta, but it's added buying pressure, which is pushing the market higher. So could we be in a gamma squeeze based on the VVIX being all the way down at these lows? Could be a possibility, which again is not a bullish or bearish implication. It's just trying to understand more firmly who are the participants in the market. Is this true buying pressure, or is it slightly skewed based on the lack of hedging activity? Rather, is what we're trying to uncover with that one. All right. Getting back down to what might be a little bit more familiar here, let's take a look at the SPY daily chart and see what's going on from this perspective. So lots of lines on the charts, I know, I get it, but they're all important, especially as day traders here in this current environment. So just like we talked about in many of the sectors, here was a balanced range. Many of the sectors had ascending triangles. The SPY not so much when we made this equal low from here to here. That's besides the point. What is the point, though, is the fact that we've had a break, retest, and we've rallied off of that. If you were tuned in to the pre-market live stream today, I said you could not, one more time I'll say it, you could not be bearish on the SPY until we took out 389.75 to the downside. Did that happen today? The answer is absolutely not. Absolutely not. I mean, guys, how can you make a beautiful higher low like this right off of a technical level and still continue to hold a bearish slant? Now, in the grand scheme of things, I suppose if you've got like, a multi-month time frame, sure, you could make the argument that this to this to this is a lower high. Maybe we're trickling back lower in the future. But in the short term for day trades, guys, read the chart, take the chart for what it is, this higher low off of a very nuanced level, and then the gap green over red today, beautiful setup to the upside. It's all making sense is what I'm getting at. So we are looking for continuation to the upside to see if we can make it to that weekly high volume node that we've been discussing on the Sunday/Saturday videos up towards 408 and 415. Now, those are two levels that you would want to have in mind. If we do get continuation out of the gates, we're looking at 408.25 as being the first major resistance. Not only is it extended from the weekly expected move, but it's also the first area where any of this overhead supply could sell for a break even if anyone's holding from there and just wants out, right? They don't want to be involved anymore. They just want out. That's the first place that they'll start to sell. So 408.25, carry that forward as the most important resistance into the remainder of the week. If we just consolidate out sideways, ideally another higher low is developed, and that would be above 395.75. I can show you that level on something like an hourly chart. If I zoom in here, notice that it was big resistance in this area. We failed, and that's where the lower high came from. We also failed there right here into the close, right? The next day we gap down and sort of do this, and now we're back above that. Notice also that right as the FOMC rally was taking place, we held that for support as well, 395.75. If there's a pullback, a deeper pullback out there, we want to see that hold. Well, I suppose that would actually be shallow from the daily time frame, but ultimately that holds and then continuation. And if it doesn't, again, your line in the sand is 389.75. I don't know how to make it any more clear. If we're not underneath 389.75, there is no reason to be bearish just yet. So that's what we've got on the SPY daily time frame and the hourly. Let's take a quick peek at the internals just to round out the SPY, the S&P 500 marketplace here. If you don't know about this one, I've got a video in the top right-hand corner. It's a little tutorial for you. It's going to show you what this is, how to set it up, how it'll help you make better intraday trading decisions. The main takeaway from this is that the internals too are supporting all of the bullish activity that we've seen thus far. On Monday, it was really more of a neutral day than anything here, but still an inflow. Tuesday outflow, but nonetheless, look at the extreme inflows on the FOMC. Like this to me is new money buying. That's not just short covering. That's not just retail that's jumping, and that is some serious buying to go from, let's see, what is that, 130, let's call it 140 million to close out at 438 million in terms of net volume inflows to the S&P 500s. I mean, that's serious stuff, right? So I do look at that as being a significant marker for new participants in the marketplace here. The next thing would be the advanced decline line. Again, neutral on Monday, even neutral on Tuesday with the sell that we saw there. It's not like it was pegged down below in the negative trend zone here. And on today's session, again, look at how we close out, a nice ramp into the close. And even throughout the morning session there, we were well above the 1,000 read. So that strikes me as bullish as well. Ticks, pretty neutral. And again, nice confirmation on today's session, even with the volatility that we saw, overwhelmingly bullish on the day's session. So this too is confirming sort of the bullish slant that we've had here in the marketplace. Now, the next thing that we're going to look at is very, very important. This is the market profile here. If you don't know what this is, I've just told you what it is, number one. But number two, if you want to understand it, check out that video in the top right-hand corner. The reason that this is so important is because if we do see a pullback, and if this move was a little bit extended to the upside, if you will, then single prints are going to make trading the downside very, very simple, okay? You can basically see, for all intents and purposes, on today's session, we have a double distribution. We have this, and we have this, and it's separated by a string of single prints right around in here. Why are single prints important? Because the volume there is virtually non-existent. We treat this area very similar to a gap. So if the market is going to remain optimally bullish for tomorrow's session, we will remain in the upper distribution here above what, let's put an actual number to this. That's 4,008, in the ES. If we're above 4,008, bullish digestion of the overall move, we're above the single prints. If we knock on 408 and crack through it, the first area of support that you want to look for is the single prints to fill around 39.90. If we get to 39.90 and reverse off of it, that is still a very bullish implication. We are repairing some of this structure and we're bouncing off. We're not even getting into the high volume node, bigger distribution down below. Now, if we breach 39.90, yes, a little bit more bearish. This could be a bit of a fake out and we would go from there. We'd have to see how the price action ultimately unfolds, but those levels are going to make it very, very easy for tomorrow's session. If we are above 4,008, bullish. If we are above 39.90, still bullish, slightly more neutral. We've repaired the structure. If we break 39.90, that's a little bit more concerning. We're likely going to spend some time chopping around through this big sort of high volume node area here on the market profile. That's what I wanted to point out from this perspective. Let's get back on over to the platform and round out the rest of the broad market. We've got the QQQ for the NASDAQ 100. What's going on in this one? You can see, again, lots of lines, but all important. The make or break level, just to sort of break it down and keep it simple for us today, is we've got to be above 296 by the time the week's close comes around, and I do expect that to be a likely scenario. Ideally, higher low pullbacks happen off of 302. I'll show you the hourly in just a second. And if we breach this level right here, 307.40, 311 is on the table for day trades, and ultimately the target is here around 314. On the hourly time frame, to show you that higher low pullback zone, this is the equivalent of that SPY level that we talked about where the FOMC rally stemmed from. Also notice that it's where the breakdown came from right here and the failure of the sort of neckline of the head and shoulders, right? So this was definitely kind of a pseudo head and shoulders on the hourly. We're back above that sort of right shoulder, held as support here. That's where 302 is coming from, line in the sand 296, and upside target 311 as we just pointed out on bullish moves here. Next up, IWM Russell 2000 and the small caps. What's going on in small cap land? Certainly just as bullish, if not more bullish than what we've just seen there in the QQQ. Reason being is that we have a nice break consolidation. The pullback is certainly not as aggressive. We got into that 177.60 for that break and retest ultimately. Multiple hammer candles inside bars. We take out the hammer highs and we're off to the races, setting a new higher high. We're at the dominant resistance trend line coming from the all-time highs. Would you look at that? We're finally there. So the Qs and SPY ultimately have broken their primary trend lines as of right now. The IWM is starting to sort of look like it may break as well. If we can take out this 184 zone, the next look above is at 186. That's obviously bullish pressure for the marketplace overall, and then continuation into this top here at 190.71. I do think that we can get continuation out of this pattern because, again, this strikes me as a bull flag. This is day one of a breakout. If we get day two continuation, then we are looking for that move higher. Again, this can happen happen into the end of the week. So that's the upside. If we were to break down, again, we are not bearish, we are really just more neutral in this area until 177.60 breaks. If that were to break down, yes, you can flip back to bearish, fake breakout, moving back lower. Support trend line's the first target, and then a break of that fills the triangle down to here. The triangle being referred to as that right there. That's 167.25. But again, this doesn't strike me as a likely possibility based on what we've seen thus far. So far, the chart looks fantastic for continuation to the upside. Next up, we're going to get into the core list of companies. Apple is up first on the chopping block. What's going on here? Earnings are on Thursday after the close. Please do be mindful of that. The chart continues to look absolutely great, picture perfect here. This literally belongs in a textbook. We have lows, higher lows, higher lows, higher lows, higher lows. Why is it textbook though? Because you have your higher lows off of prior resistance right here. So from this to this, resistance then flips into support, right? It's textbook stuff. So overall, in Apple, we are looking for a little bit more continuation. We essentially have what we would deem as a seller's shut-off pattern. That is from Peter Resnicek over at Shadow Trader. Certainly want to give credit where credit is due. He is one of my mentors. Whether or not he knows it, I'm unsure. But anyways, this one bar, as we would say, the seller's shut-off pattern, takes back 1, 2, 3 bars worth of selling activity in one fell swoop. That is a very, very bullish implication. All of these sellers who were thinking about becoming new money shorts are burnt. They're underwater if they're still holding. So that fuels the fire for more upside. Our next target overhead is 159.25, which is also very close to the 200 SMA there in green. And then after that, we've got 166, which is a bit of a stretch. I would not imagine that we make it here into the remainder of the week unless there's some crazy, crazy thing that happens on earnings. But I do think based on the positive earnings we saw from Microsoft and Google with the FOMC added on top, a majority of the positive news, if you will, has been priced into what we're seeing here inside of Apple. Downside gets bearish underneath 148.25. Ideally, it holds this 150.57 if we get any further chop and consolidation in here. Again, bears open up underneath 148.25. Continuing along, Netflix. What's going on here? Very similar in terms of pattern and what this green bar has done here. Sellers have been shut off from those 3 bars. We're up at the highs, obviously bull flag consolidation, inverted H, right? Depending on how you want to draw it, whatever. Your breakout level is over 228.13. Next target overhead is ultimately the bottom of the first major earnings gap down, right? So this is getting fairly interesting here inside of Netflix. If we can clear this level, which is also resistant from there on the first 2 days of consolidation, then that really does start to get very interesting for upside here inside of Netflix. That's going to be a trade I keep a close eye on. What's the reaction around 230, 228, this general area of the bull flag? So watching that like a hawk. If it does breach underneath 215, it opens the door for a back test of 202.25. That would be a short scalp, not a shift in tone immediately to the bear side, because here's your big range, right? Break, retest on the move back to it. Maybe we bounce off of it. So this is just a scalp if we trade the downside there. But everything about this bar would strike me for more upside. Tesla up next. What's going on with Tesla? Elon Musk land. Very similar. This one's not as bullish because obviously we're not up at the highs quite yet, but we did take back a majority of the pullback thus far. We are respecting the 780 level, which was the top of this balance right here on the break, retest, and go. Next trade on the long side is obviously up and over 840.64 to get to your next resistance at 875.68 for a day trade that's coming from our prior breakdown level right around in here. The downside trade is pretty tough to pull off at this point in time. I would really be patient to see if we can get a move through this gap on the downside. Other than that, it doesn't really strike me that there's any obvious bearish implications about this chart just yet. Next up, we've got Google. What's going on in Google? So big fake break, excuse me, apologies about that. Big fake breakdown on the Tuesday session, gap green over red, earnings, the whole 9 yards, everything was there for it to move higher today. We discussed that in the pre-market stream. Partial gap fill, we fished for the long, boom, we're off to the races. Now we're in the midpoint of this slop range, okay? So here is the midpoint basically for all intents and purposes. We're kind of right there. So if you missed the long off the bottom of the range, if you missed the long this morning, I'm not sure that it would be wise to chase this one right here. Can it continue? Yes. Is it likely that we could put in some consolidation first though? Probably, because we're in the midpoint of the range. If the consolidation is above 111.50, bullish in my estimation, forming a bit of a bull flag on like an hourly time frame, then looking for continuation to the top of the range at 118.75. If we were to break down, the higher low has to be above 109 here. Otherwise, this to me is really the dominant driving force, right? This resistance trend line. If we fail, lower low, get back into this, that certainly opens up the door for the next time to bring us to 102. Again, does it look likely? Not based on the pattern that's unfolding here. Use this level as your judge, 111.50. Next up, Meta. Let's go ahead and flip on I guess we'll go side to side here, and we'll go extended hours session so we can see what's going on with the earnings report here. So this is subject to change, obviously, by the time that the bell rings tomorrow morning. We'll talk about it in the pre-market live stream. That's a no-brainer there. But currently, just in the midpoint of today's range, to be quite honest. So it's not really bullish or bearish. It's still underneath. So if you think about this as a range, just like the XLC break and failure here, it's still inside of this box, which does not strike me as the most bullish implication for the marketplace overall. If Facebook, or which is now Meta, of course, were to get back up and over 172.56 and open above, then the long trade on that day would probably be looking for a gap fill overhead from 175.50 up to 178.87. Again, there's just too much of a question mark right now for me to say definitively bullish, bearish, neutral, whatever. Just in the midpoint of this range, if I had to say anything, I would just be a little bit more cautious around Meta as opposed to overly biased one way or another based on the earnings results. Next up, we've got NVIDIA. What's going on in the chip making land? We'll go ahead and just pop this back to maximize. Here we go. So there's a quick tip for you. If you didn't know about that in Thinkorswim, you can maximize a sell, and that's ultimately what gives you these two arrows. I've had people ask me about that in the past. That's how that works. That's besides the point. What do we see in NVIDIA? Inverted head and shoulders, right? So it's still kind of in play. Your breakout level is up around 180, 125. To clear through this range in here, target would be the top around 192. Today's bar is a green gap over red, of course, which was a bullish setup here. We filled the gaps or repaired the structure. And now what we want to see happen is higher low pullbacks respect this 174 level. So if we go on down to the hourly time frame, we can turn off our extended hours now. We don't really need that. You can see resistance, resistance, right? In here, it's where the breakdown came from. Now that we've recaptured that, that's got to hold up for support now for that higher low to preserve the daily pattern that we're ultimately looking for, which is the break of 180, 125. Anything that gets down and dirty underneath 169.50, much more neutral and choppy in here, and a failure of this double bottom neckline at 159.70, that opens up the doors for shorts in my estimation. I would be much more cautious and neutral in this area than overly biased to the downside. Next up, Microsoft. Big sort of turnaround from earnings, right? We had this multi-day balance that we had been discussing, really bearish breakdown on Tuesday. Today, we're right back out of the top, but more importantly, we're getting into this breakout zone here around 267.25. Can we get continuation is the question. This is the first target at 273.50, and then after that, I don't think that this is going to happen to the end of the week, but this is the next target around 285.75. That would probably be something reserved for either next week, or maybe we put in a period of consolidation and then breakout. I'm not entirely sure. I just don't think it's happening into Friday. This is a range, and if it were to double, oops, let's go ahead and grab that. There we go. That takes us to 280. And again, notice that there's not a whole lot in this section before we hit that next resistance. This was a major breakdown point, which is why that's the level at 285.75. So nonetheless, what I'm getting at here in Microsoft is impressive turnaround. Now it's got to stay above, worst case scenario, it's got to stay above 265, we'll call it for round number's sake. If it fails back down into this box from right here, much more neutral, choppy, sloppy, I would stay far away or just stick to scalps only inside of Microsoft. Last but not least, the mini beast, we've got Amazon. What's going on in Amazon? You can see again a clear reversal here. Thursday after the close are earnings, so do be mindful of that. We filled the gap overhead. That strikes me as a bullish repair of structure. Also, this was a inverted hammer essentially on the Tuesday session underneath 117, which was the top of this prior range from right around in here. The fact that we held above that all day on today's session strikes me as a bullish implication just from a psychology perspective. This probably trapped a lot of shorts there on the failure retest of 117 from the top, bottom down, right? So now that that's happened, the next step would essentially be consolidating in here and then squeeze out those shorts, and boom, your next break is into the bottom of the gap, 130.78 from 125.25. So that's what we're watching for inside of Amazon. If it's going to be bearish, it's got to be back down underneath 117, then short the inverted hammer low to get to here at 107, roughly, we'll call it for round number's sake. But again, nothing about this bar would imply that the bears are set to take control. Let's get into these two trade ideas, then I'll send you on your way. The first one is simple. It's on KO. Coca-Cola, they've already got earnings out of the way. What I'm looking at here is this resistance trend line. Boom, something like that. We wicked through it on the Tuesday session. On today's session, hammer candle printed. So we filled the gap underneath from the earnings. So that structure has been repaired. If we take out the hammer high and the resistance trend line, kind of off to the races to the upside, looking for some bullish lift here. The first target on like a day trade scalp would be 64.50. So that would kind of be in that high set right there. Let's go ahead and map that out. And then from there, you get a little bit more continuation into 66.13, 66. 1.36 even. So that's how I would trade Coca-Cola here on a break of the trend line. Again, I'm not much of a swing trader, but I would just be looking for bullish activity on the intraday, bullish setups on the scalps on the intraday in sort of this range, right? When you have a daily pattern combined with a smaller time frame pattern, chances of success generally increase. Let's go ahead and take a look at the last one here, which is LCID, Lucid. We have not looked at this in quite some time, but I do like the setup that's unfolding here. New uptrend is kind of in place with these higher lows. We did set a higher high, so pulling back into the trend line strikes me as viable. Look at the candle that printed on today's session. It's a really, really tiny hammer candle in there. If we were to take out the highs and the 50 SMA here around 1850, there's clearly clearance, no pun intended, up to 2030, right? And that would bring us back to the top of the ascending triangle. So I like that as a setup here. Yes, this technically is a fake breakout, but the fact that this is holding right at the trend line, the fact that we printed the hammer candle, the fact that it would be a break of the 50 SMA and this level, which was prior support and now resistance, it all just makes sense to me with tight risk, right? Even if your entry is here and you're a swing trader, where's your stop go? Right under the lows, right? What's your reward? Up here. That's at least a 2-to-1. If you can move your stop to break even as soon as possible, there you go. You've got a free trade on your hands. Please just be mindful of earnings around the corner if you do decide to swing this one. So that's what I've got for you on today's session. If you enjoyed the video or learned anything new, let me know in the comment section or by giving the video a thumbs up. Don't forget that we will be live at 8:30 tomorrow morning, and I won't be around for the weekend, right? So again, just like last week, we're going to have a shortened stream on Friday, and the video will probably come out at a weird hour on this Sunday morning or Saturday night, depending on timing, but nonetheless, a video will come out. So I appreciate you all tuning in, and I wish you all a green trading week.